first judgment of the day, which has in a way created problems for a large number of SSEs. And to put it mildly, it has unsettled the law which was there throughout the country, accepted and being implemented, except for, of course, I am from Gujarat, therefore we were mentally ready for this kind of judgment. However, no other state except for Gujarat and Kerala was ready for this kind of a judgment. The judgment in the case of Checkmate Services Limited, which was delivered by the Supreme Court on 12th of October 2022. Let us understand the facts first. Factually, there is not much of a controversy insofar as the judgment is concerned. The question is one of allowance of employees' contribution while computing the business income. All of us are aware that as a businessman, the businessman has to discharge the liabilities of employees' provident fund, EPF, and ESI, employees' state insurance schemes, etc. All these entitlements, that is employees' provident funds as well as employees' state insurance funds, etc., are required to be paid into the government treasury by the employer, namely the SSE, for and on behalf of its various employees. Under the scheme of the Act, there are two sections which are broadly controlling the allowance of this expenditure. Section 36(1)(4), that is small Roman 4, that is the section which is there for the purpose of granting the allowance on account of employer's contribution. We have section 36(1)(5)(a), that is small Roman 5(a), that governs the allowance of employees' contribution. On the top of this, we also have section 43 capital B, which is otherwise a general section, which says that the SSE would get any expenditure as an allowable expenditure, provided the same has actually been discharged, the same has actually been paid. Even if the SSE follows mercantile system of accounting, 43B is an exception to that mercantile system of accounting. And the emphasis here is on the actual payment. Therefore, the position is that an SSE who is an employer, he has to pay all these contributions, not only on his behalf, but also on behalf of his employees. Insofar as 36(1)(4) and 43B, the position was quite settled, and in fact, it is settled even today also. The situation is that the moment an employer pays the money into the government treasury, even if beyond the due date as prescribed under the respective PF and ESI Acts, so long as it is paid before the due date of filing of return of income, it is available as an allowable expenditure in the hands of the employer SSE. The question or the issue which was pending, and there were diverse views of various high courts across the country, Gujarat and Kerala taking a view against the SSE, whereas rest of the country was in favor of the SSE. The view was that how the employee's contribution is required to be allowed in the hands of the employer. Employee's contribution is governed by 36(1)(5)(a). The section says that the amount which is received by an employer from his employees for the purpose of onward deposit into the government treasury, if that amount is not deposited into the government treasury before the due date, and mind you here, the due date is as per the respective acts, namely Employees Provident Fund EPF Act and ESI Act, not the due date as contemplated under the Income Tax Act. Therefore, here the position is that as an employer, I collect the money, I receive the money from the employees from whose salary I deduct these amounts, which are to be paid in the government treasury, and if I do not pay that amount into the government treasury within the due date as prescribed under the respective acts, the amount would become income in my hand by virtue of 2 into bracket 24x, that is 24 subclause 10. Now, the SSCs across the country were arguing that, sir, when section 43B, the proviso got inserted with effect from 1/4/2003, that proviso would govern even the employee's contribution. And therefore, even if the due dates of the respective statute is, so long as the amount is paid into the government treasury before the due date of filing of return of income, the said amount would be available as an allowable expenditure in the hands of the SSC. The department, the income tax department, had a different take. According to the income tax department, 3615A is governed by 3615A alone, and that is not influenced by section 43B, and therefore any amendment carried out in the 43B can only have its effect on 3614 and not on 3615A. In the facts of the present case, admittedly, there was a payment into the government treasury of all the amounts, namely EPF and ESI amounts, beyond the due date prescribed under the respective statutes. However, before the filing of the return of income, the SSC in question has paid this amount into the government treasury. So the situation was that though the amount was paid belatedly under the PF and ESI Act, before filing of return of income, the amount was admittedly paid into the government treasury. One more factor which is required to be taken into consideration is the fact that while paying the amount into the treasury, the SSC in question has already paid the interest as well as late fees while depositing the amount. So under the respective statutes, the amounts were paid belatedly along with the interest leviable as per those statutes, along with the late fees leviable under those statutes. And therefore, the payments under the respective statutes were regularized. However, the assessing officer, taking shelter of 3615A, disallowed this amount in the hands of the SSC. The matter was carried before the commissioner. Commissioner dismissed the appeal of the SSC. The matter was carried before the tribunal. Tribunal also dismissed the appeal of the SSC. The matter reached the High Court. High Court, by a speaking order, dismissed the case of the SSC on the ground that 43B has no application insofar as 3615A is concerned. And therefore, this amount, which is admittedly paid belatedly into the government treasury under the respective statutes, the amount is not available as an allowable expenditure. Matter was argued before the Supreme Court. Supreme Court, taking note of the fact that all the high courts except Gujarat and Kerala took the view in favor of the SSC. This was an appeal which has arisen out of the judgment of the Gujarat High Court. The main argument before the Supreme Court from the SSC side were to the effect that the issue is now concluded by the judgment of alum extrusion. All of us are aware that in 2003, when 43B proviso was added, or there was a deletion of the certain terms from the respective statute, and proviso to the effect that so long as the money is paid into the government treasury before the due date of filing of the return of income, all those payments which are contemplated under 43B, namely interest, statutory dues, PF, ESI dues, etc., would be available as an allowable deduction in the same year in which the amount is paid. That amendment was prospective one. It was introduced, it was inserted into the statute book with effect from 1/4/2003. The argument from the SSC side was that, sir, this is a curative amendment. This is an explanatory amendment. It has been inserted with a view to remove a mischief. And therefore, this is a beneficial amendment. You must interpret this amendment to have a retrospective effect. court ultimately held in the case of alum extrusion that you are right. This is an amendment which has been brought specifically to deal with an anomaly. And therefore, we will interpret this amendment to have a retrospective effect with effect from 1987, when the original statutory provision was introduced into the statute book. So alum extrusion said that 43B, the proviso, more particularly concerning clause B, namely employee, the contribution by the employer, all those aspects were considered to be having a retrospective effect right from 1/4/1987 or 1/4/1989 to be precise, because Finance Act 1987 brought in the amendment with effect from 1/4/1989. So the main argument of the SSE was that alum extrusion would deal with the situation, because alum extrusion says that 43B employees, the employer's contribution under small clause B would take care of the contribution from both SSEs as well as the employees as well as the employer's contribution. The argument was that 43B talks about contribution. Now, contribution has meaning prescribed under both the respective acts, namely one set is PF and ESI Act, wherein the term contribution is defined. The respective acts defines contribution to have a collective meaning, namely contribution would include not only employees' contribution, but it also includes employers' contribution. Therefore, the word contribution is defined under the respective acts as inclusive of both employees' contribution and employers' contribution. Under the Income Tax Act, Schedule 4, the definition of contribution is in Part 2, definition of contribution is given. And even that definition also includes the contribution on account of employee as well as employer. And therefore, the argument was that the word contribution, as generally understood, includes the contribution from both employee as well as employer. And therefore, 43B, when it uses the term contribution, it includes both employer's contribution as well as employee's contribution. 43B having already been held to be retrospective by alum extrusion, therefore that judgment would even govern the present situation, wherein independent of employer's contribution, employee's contribution was a subject matter of controversy. Therefore, that was the first argument which was raised before the Honorable Supreme Court, that alum extrusion is a simple answer to the present controversy, and therefore you must follow the judgment of alum extrusion. The second argument was that you look at the entire scheme of the Act. If you look at the entire scheme of the Act, you would realize that right from the inception, both the employee's contribution and the employer's contribution have always been treated at par. There was no distinction between both of them. The only time when such a distinction is created was in 2003, when the 43B is amended, and there the only part which is covered is 36(1)(4) and not 36(1)(5)(a). Therefore, the submission was that even this is an anomaly, and you interpret section 43B in such a way so as to include even the so as to include employees' contribution. The third argument, and in fact, probably that is the argument was not considered by the Honorable Supreme Court in the final analysis, but what was argued was this, that, sir, you look at the language of 36(1)(5)(a) and you look at the language of 2(24)10. They both talk about a situation where amount is received by an employer from his employees for the purpose of paying into the government treasury. The term receipt is different than deduction, because all of us, we understand that under the Income Tax Act, both terms, the receipt as well as deduction, are having different connotation. In fact, in the provisions concerning TDS, we know this difference very well, that receipt and deduction are both on a different footing. And therefore, if Parliament wanted, Parliament would have said that any sum which is deducted by the employer would become income by virtue of 2 into bracket 2410. However, Parliament in its own wisdom uses the term receipt. And therefore, what was canvassed before Honorable the Supreme Court was that, sir, you have to give meaning to the term receipt while examining the provisions of 22410 read with 3615A. And therefore, when you are interpreting the provision, the situation in the present case is that it is only a deduction from the salary, which we are talking about. It is not a receipt from an employee. Because it is not a receipt from an employee, the provisions of 3615A and 224 into bracket 10 would not get attracted at all. Those provisions, that is 3615A and 22410, would get attracted only when a situation arises where, as an employer, one receives the money for and on behalf of his employees for the purpose of onward deposit into the government treasury. And for that, respective provisions of EPF and as well as ESIX were pointed out that such a situation is also contemplated, where as an employer, I receive the money from my subcontractor, where the employees are working under a subcontractor. What the subcontractor would do is he would collect this money while paying the salary to his respective employees. He would hand over this money to his principal contractor, and that principal contractor under the law would deposit that money into the government treasury. And therefore, what was canvassed before the Supreme Court was that only under such a situation where the money is actually received by an employer for the purpose of depositing into government treasury, such a provision would get attracted. Otherwise, under a normal circumstances where the money is simply deducted from the salary, there is no question of 3615A read with 22410 getting attracted. These were the arguments which were made before Honorable the Supreme Court. It was also pointed out that, sir, you look at the Kelkar Committee's recommendation in 2003. The Kelkar Committee was constituted purely for the purpose of the removal of a defect which was there in the statutory provision, wherein large number of SSCs made representations before the government agencies that, sir, while we are dealing with employees, when we pay all these contributions into the government treasury, there is bound to be some delay. The March contribution would ordinarily be deposited into the government treasury, even under those respective statutes, by May. And therefore, if you look at the overall scheme, even the regular payment would get disallowed. And once it is disallowed, kindly appreciate, this is not a provision where the deduction is available on a payment basis. This is a provision which is a unique provision under the entire Income Tax Act, where a violation under another act attracts complete disallowance of an expenditure in the hands of the SSC. So it is not a deferred allowance of an expenditure that you pay in the next year, you get it in the next year. It is not like that. Normal 43B would operate in that way. But this is one section or one clause of 43B read with 36(1), 4 and 5A, where if you miss the deadline, you would lose the deduction for all times to come. Kelkar Committee, having realized this aspect, recommended that appropriate amendments are required in 2003. And therefore, one of the arguments before the Supreme Court was that Kelkar Committee's recommendations would apply to both employees' contribution as well as employers' contribution. And therefore, if you really want to implement this recommendation of the committee in its proper perspective, you must read it in such a way so as to cover both these contributions. Revenue's contention was that you look at the scheme. The scheme is that both these deductions are otherwise covered right from 1961 under 36(1)(4) only. It was only in 1987 that for the first time there was a distinction made between employees' contribution and employers' contribution. Simultaneous amendments were carried out in 87 with effect from 89 to the effect that one, employees' contribution would start getting governed by 36(1)(5)(a). Two, there was a simultaneous insertion of 2 into bracket 24 clause 10 in the income definition, wherein this deduction was converted into income. Thereafter, it would be available as an allowable expenditure under 36(1)(5)(a). The argument of the revenue is that this amendment was done specifically keeping in mind the welfare of the employees. Therefore, the moment an employer deducts the contribution for and on behalf of his employee, that contribution in the first instance would become his income under 224. That income can be claimed as an allowable expenditure only if it is paid into the government treasury as per the mandate of 3615A. This was in a way money which was lying with the SSCs in its trustee capacity, and because it is lying with the SSC in a fiduciary capacity, the provisions are more rigorous. They demand more compliance and timely compliance. So therefore, revenue's case was that, sir, you can't segregate or you can't read 43B so as to cover this segregated expenditure under 3614 and 3615A. You have to give different treatment, and that is what the Parliament always wanted right from 1987, that these two contributions are required to be treated separately. And therefore, the argument of the revenue was that 43B can only govern 3614, because 3614 does not have any mandate as regards payment into the government treasury within the due dates as prescribed under the respective statutes. It is only 3615A which has such a mandate. And therefore, the argument of the revenue is that, sir, you can't read the curative provisions of 43B into 3615A, and therefore the SSC is wrong when SSC submits that you read 43B into 3615A. Supreme Court, after having analyzed the entire issue, has reached to this conclusion, and that conclusion is that 3615A is a standalone section. It is not governed by 43B, and therefore, if an SSC wants to claim an expenditure under 3615A, SSC has to fulfill the conditions of 3615A. The Supreme Court was very categorical. Supreme Court said that whenever a particular statute is very clear, the language of that particular provision is unambiguous, then you cannot take a shelter that in the guise of interpreting a provision, you reread the provision and reduce the rigors of such a provision in such a way so as to make available a deduction which is not available to an SSC who misses the bus of paying the contribution in time. This was the view of the Supreme Court. Supreme Court, after having analyzed what has been analyzed by the Supreme Court is all the provisions of 3615A, 3614, 43B, respective provisions of PF and ESIX, and ultimately the analysis is that firstly, alum extrusion would not cover this situation because alum extrusion is extensively reproduced by the Supreme Court. They said that alum extrusion does not deal with the issue of 3615A at all. It only deals with the issue as regards 43B read with 3614. Therefore, it is only vis-a-vis employer's contribution and not about employees' contribution at all. Therefore, once it is held that alum extrusion is not covering this issue, obviously the Supreme Court has to then analyze the facts of this case and find out whether in the facts of this case and large number of other SSCs, such a deduction is allowable or no. Supreme Court thereafter analyzed the entire law on the issue and reached to the conclusion that the mandate of the section is very clear. It agreed with the revenue submission that yes, the moment a sum is deducted from an employee's salary, that would become an income in the hands of the principal, that is the employer, and that income would be allowable as an allowable expenditure only if the amount is deposited into the government treasury under under the respective provisions within the due dates as defined under those respective acts. The due date also, kindly mark one aspect of the matter, because most of the time we believe that under the PF Act, the grace period is still available. However, that has been clarified by the Supreme Court, and that was also submitted before the Supreme Court, that the grace period of 5 days, that is under the PF Act, the law says that after the end of the month, within next 15 days, we have to pay into the government treasury the respective contribution. Now, those 15 days would not, that is a standalone provision. Up to 2016, there was a grace period of 5 days which was available. And therefore, up to 2016, it was end of the month plus 20 days. That is 15 normal plus 5 days grace period. However, after 2016, that the period of grace period of 5 days is now taken away by another circular issued by the EPF authorities. Therefore, now the period is only of 15 days. Therefore, when we are computing the period for the purpose of depositing into the government treasury of respective contribution, we only have 15 days from the end of the month. Insofar as ESI Act is concerned, the period is 21 days. Therefore, under both the acts, the period of deposit is different. And therefore, while reporting into the audit report, etc., one has to keep this aspect in mind. Sorry. And therefore, Supreme Court, in a way, ultimately upheld the judgment of the Gujarat High Court, read with Kerala High Court, and upturned, reversed the judgments of all other high courts while delivering the judgment on this issue. There is one aspect of the matter which I must admit that Supreme Court has not dealt with the argument as regards receipt versus payment, because under the normal parlance, one would interpret receipt equivalent to deduction. However, a specific argument was raised to the effect that in the hands of the respective SSC employers, a receipt is different than a deduction. And if Parliament so wanted, Parliament could have used the word deducted. So Parliament could have said that any sum which is deducted from the salary would become income under 224, or Parliament would have said that any sum which is deducted would be available as a deduction, allowable expenditure under 36(1)(5)(a) only upon payment into the government treasury within the due date. However, at both the places, the term uses receipt. However, that argument is not considered by the Supreme Court. Other than that, Supreme Court has ultimately passed a judgment wherein the view which is taken is now, today, what is the situation? Situation today is that whenever an employer has to pay into the government treasury a contribution on behalf of his employees, he has to make sure that he pays into the government treasury the contribution within the due dates. EPF within 15 days from the end of the month, and ESI within 21 days from the end of the month. The moment there is even a 1-day lapse, he loses the deduction for all times to come. He cannot claim it even on a payment basis, such a deduction. And therefore, the next question would be that is there any provision under the respective acts whereby I can only pay employees contribution and I can defer employers contribution, because I have an option of paying employers contribution right up to due date of filing of return of income. So I have let's say a 6 months period available with me for the purpose of paying over that contribution into the government treasury from the end of the respective previous year. If we look at the EPF and ESI Act, we find that there is no such provision whereby I can pay part of the contribution now and I can pay part of the contribution later. As mentioned earlier, there is only one provision, there is only one definition of contribution, and that governs the entire deposit of contribution into the government treasury. And according to that definition under the respective acts, contribution means both employees' contribution as well as employers' contribution. Therefore, one has to now make sure that whatever is the contribution, namely employers' contribution or employees' contribution, the entire sum is required to be paid into the government treasury, because there is no splitting of contribution payment available under the respective acts. You have to pay everything within the permissible time limit. Otherwise, you may lose at least the employees' deduction for all times to come. You can get employers' contribution as an allowable expenditure, even if on a payment basis later on, provided you pay it before the due date of filing of return of income. But you would lose the employees' contribution for all times to come. Now, what would be the consequence? What are the issues which are likely to arise because of this judgment? The first issue would be that all those judgments of the respective high courts would be reversed. So therefore, the SSCs who have succeeded before the respective high courts, their judgments would be reversed, and those demands would once again be raised. But that in any case was a pending litigation, and therefore that was bound to happen. What is more scarier or what is more worrisome is the fact that now with the availability of this judgment, it is open to the revenue authorities to take remedial measures. And those remedial measures include 154, 254.2, 148, and 263. All those remedial measures can be taken against an SSE on the ground that now the law is settled, the interpretation is of the Supreme Court. Howsoever strong we feel about the interpretation, ultimately it's an interpretation of the Supreme, the apex court of the country, and therefore we have no option but to accept this. Revenue authorities would start taking the remedial measures. Under the new 148 scheme, we have 148 explanation 1, which defines the information. Information clause 5 says that any action which can be taken as a consequence or as a result of a judgment of any court or tribunal. So this is one such judgment which can be used as an information under clause 5, and reopening can take place. Or in fact, income tax department can take cognizance of this judgment. They might upload on the Insight portal that wherever there is any employee's contribution, you start taking remedial measures, or in the hands of the SSEs, this employee's contribution is required to be disallowed for a period subject to law of limitation. Wherever it is available, you start taking those actions. So those remedial measures could start very soon, and in the hands of large number of SSEs, this can become a nightmarish situation, because for this reason, the concluded assessments could be reopened, or 254.2 before the tribunal, or on 154 before even the appellate authorities can be filed. Because all of us are aware that Supreme Court judgments, whenever Supreme Court declares any law, the legal consequences that the law was always like that. It is only the law which is pronounced by the Supreme Court. So it is not that with effect from 12th October 2022, we have a different law. The settled position is under Article 121 that Supreme Court declares the law. And declaration of law means that law was always like this. It is only now it is being interpreted by the Supreme Court so as to make the position clear. Therefore, it has a retrospective effect. Once the law has a retrospective effect, all of us are aware that it has certain unwanted or undesired consequences. So though we have to be ready for those consequences. Apart from that, while we are signing the audit reports, we also have to keep in mind that now onwards we have to report these transactions. If at all the payment is beyond the due date, we have to indicate that separately in our audit report. We cannot take shelter of the jurisdictional high court judgment that so long as it is paid before the due date of filing of return, there is no disallowance which is called for. Friends, this is one judgment which would have again a far-reaching consequences. It will give rise to unwanted, undesired litigation, and it will increase the compliance burden on the part of all the professional friends. And SSEs would also suffer, because here they are losing the deduction for all times to come. In fact, it was pleaded before the Supreme Court that unlike other provisions, here the SSE loses a chance to claim that expenditure if at a future date altogether. That chance is gone. Supreme Court said that if that is the intention of the Parliament, we can't read anything beyond that. So friends, this is one judgment which is against the SSE, and in times to come, there is going to be a huge, I would say, undesired consequences which we are waiting, and that is going to happen. Do we take the question answers now on this, or we move forward?
Move, sir. You explained very in great detail, sir. You can move.
Gee, we can move.
Yeah.
All right. The second judgment is with respect to 127. All of us are aware that section 127 is a provision under the Income Tax Act which decides the jurisdiction of an SSE as to which officer or which authority at what place would carry out the work of assessment. So 127 in a way is a provision which confers power to the authorities that whether a case needs any transfer from one jurisdiction to another jurisdiction. In a way, 127 decides, read with 124, as to what is going to be the jurisdiction for the purpose of the assessing authority to take appropriate actions in your case. 127 has broadly 4 parts. 127 subsection 1 talks about transferring the case within one commissionerate where the boss is the same, and he transfers the case from one city to another city. Supposing in the state of Gujarat, we have one principal chief commissioner or more than one. And if both the authorities, namely the transferor assessing officer and the transferee assessing officer, both are within that same authorities, falling within the supervisory jurisdiction of that same authority, 127(1) would come into play. The basic condition is that 127, number 1, there needs to be a reason for transfer. And number 2, before a transfer takes place, there has to be a reasonable opportunity given to the SSE. Broadly, these are the 2 conditions which are required to be fulfilled before a transfer can take place. Subsection 2 of 127 talks about a multi-jurisdictional transfer where case is required to be transferred from, let's say, Maharashtra to Punjab. So Maharashtra and Punjab both will have different bosses, and therefore those 2 bosses will have to agree. If transferor's boss and transferee assessing authority's boss, both of their supervisory or higher authority will have to agree on the transfer. If both agree, transfer can take place. If both do not agree, then the board will decide based on various parameters. Subsection 3 of 127 says that if at all the transfer is within the city, that is within the city, locality, or a place. So it's a local transfer. We popularly call it a local transfer. If at all it is a local transfer, then there is no need to give any hearing to the SSE. There is no need of giving any opportunity of hearing the SSE. It can be done as an administrative function, pure and simple. Subsection 4 of 127 talks about the transfer can take place at any stage of the proceedings. If at all proceedings are already over, transfer can still take place, and whatever proceedings which are completed, the files of those proceedings would be sent to the transferee from the transferor officer. If at all some proceedings are in the process, even at that stage also transfer can take place. And even if some proceedings which are required to be initiated at a later stage, even that also will not come in the way insofar as 127 transfer is concerned. The definition of case is given in explanation to 127, and that would include all kinds of material, past, present, and future material. Everything would be considered as a case. And once the case is transferred in a lock, stock, and barrel manner, everything would be transferred to the transferee officer. The interesting question which arose before the Honorable Supreme Court was with respect to which is the jurisdictional high court insofar as such a transfer is concerned. Let us look at the facts first. The facts were that originally the SSE before the Supreme Court was assessed at Delhi. So the assessing officer sitting in Delhi passed the assessment order. The order was pending in some stage of appeal. A search took place in Punjab. In that Punjab search, the authorities realized that centralization is required for the purpose of effective and coordinated investigation. Therefore, all the cases concerning that search, of which the SSE was also a part, were transferred and centralized at Ghaziabad, that is Uttar Pradesh. Now, pending that Ghaziabad, Uttar Pradesh assessment for earlier assessment, that is 6/7 to 13/14, once again there was a recentralization, and the SSE's case was transferred to Chandigarh, that is again within the jurisdictional High Court, Punjab and Haryana High Court's jurisdiction. So it was once again transferred to Chandigarh. When the appeals came to be filed, the SSE filed the appeal before the Punjab and Haryana High Court, and the revenue filed the appeal before the Delhi High Court. Punjab and Haryana High Court took the view that because the original authority which passed the order was in Delhi, therefore we do not have jurisdiction, therefore you file appropriate appeal before the Delhi High Court. Incidentally, Delhi High Court also took the view that presently the assessing officer sits in Punjab, and therefore we do not have the jurisdiction. Therefore, they said that your appeal is not maintainable. Therefore, both the cross appeals of the SSE as well as the revenue were dismissed for want of jurisdiction. And for the first time probably, the both of them went before the Supreme Court with a single prayer that, sir, high courts are wrong. In fact, this is the Supreme Court has duly noted that for the first time we are coming across an income tax case where both the SSC's council as well as Revenue's council have given us combined submission. So both of them were pleading only for one thing, that, sir, you decide which is the appropriate high court which must hear our case, because some high court will have to hear the case. It is not that both Delhi and Punjab and Haryana, they cannot refuse to hear the case of the SSC, and therefore Supreme Court has discussed the entire law on the issue and ultimately reached to the conclusion. And the conclusion is this, that we look at the issue from the point of view of the assessing officer. Therefore, it is the situs. In fact, the judgment of the Delhi High Court, the old judgment of the Delhi High Court, I'll give you the citation. Seth Banarasi Das Gupta, that is 113 ITR 817 Delhi. That was the first decision which has laid down the law on the issue. And in Seth Banarasi Das Gupta, the issue was that whose situs will decide the jurisdiction of the High Court, whether it is the SSC's situs, SSC's place of business, or it is the revenue authority's physical location, which would decide or which would confer the jurisdiction upon the respective High Court. Delhi High Court in 113 ITR ultimately took the view that it is always the assessing authority's situs which would decide the jurisdiction. Otherwise, in a earlier example, let's say Gujarat was against the SSC insofar as 43B read with 3615A was concerned, and Bombay was in favor of the SSC. Those SSCs having a much larger disallowance under the section would transfer their register office to Mumbai, and they start filing tax appeals before the Mumbai High Court. They'll start getting the favorable orders. In order to avoid that kind of a situation, so that there is no forum shopping done by the SSCs, Delhi High Court in 113 ITR took the view that it is always the situs of the assessing officer which would decide the issue. However, if that situs has undergone a change, kindly appreciate that that situs has undergone a multiple changes, then how would the jurisdiction will get decided? Whether you decide the jurisdiction based on the authority which has passed the assessment order, or you decide the jurisdiction based on the authority which is at present within the territorial jurisdiction of a particular High Court. In this case, what has happened was, when the order was passed, it was within the Delhi High Court's territorial jurisdiction. However, by the time the tax appeals came to be filed, the officer was physically located. SSC, the officer having jurisdiction over the SSC was physically located in Chandigarh, that is falling within the purview of territorial jurisdiction of Punjab and Haryana High Court. Therefore, Supreme Court finally took the view that it is the original authority which has passed the order, namely the authority which has passed the assessment order, that would decide the jurisdiction of the High Court. So it is not that presently the AO is in X state, that therefore the High Court of that particular state will have the jurisdiction. You always look at the person, the assessing authority, which has passed the order for the purpose of deciding the jurisdiction of the High Court. Because the term High Court, as well as the term High Court, is defined under Section 269 of the Income Tax Act. High Court means High Court having a territorial jurisdiction over the case. And under Section 260 capital A, the tax appeal lies before the High Court. And therefore, that High Court is the High Court within whose territorial jurisdiction the original assessment order is passed. And therefore, Supreme Court has for once and all settled the position as regards who would have the right, which High Court will have a right to decide the particular tax appeal. However, this is not the end of it. There are some controversies which are likely to arise, and that again will have to be resolved by some court at some stage. The first and the foremost controversy is that whether this judgment, which is decided under 127, read with 260 capital A, will have any material bearing insofar as the writ jurisdiction of the High Court is concerned. In my respectful opinion, the writ jurisdiction of the High Court gets decided under Article 226, 227 of the Constitution of India. And 226, 227, they follow the methodology or the test of cause of action. Now, under 226, Article 226, sub-article 2, the writ would lie before a high court even if a part cause of action has taken place in that particular state. So let us take an example that an SSA who is otherwise filing its return of income in Mumbai, his original assessment order is done in Mumbai. Therefore, his original assessment is done at Mumbai, and therefore, as per Supreme Court, the appeals, all future appeals with respect to that particular year would lie before the Mumbai High Court. Now, eventually, that SSC has shifted to Ahmedabad, let's say Gujarat High Court. Since last 3 years, the SSC is filing its return of income all under the purview of filing from Gujarat. It has already made an application of shifting of his PAN from Mumbai to Ahmedabad. It has also made an application under section 127 for the purpose of transfer of all his records. Pending that application, reopening notice is now issued to him in the state of Gujarat because his address is that of Gujarat. However, the same is issued by the assessing authority situated in Mumbai because Mumbai would still claim that we have the jurisdiction over that assessing. So where would the writ lie? As per Article 226(2), the writ would lie before both the high courts because part cause of action has arisen in Mumbai as well as part cause of action has arisen in Gujarat. The assessing authority which has initiated the action is sitting in Mumbai. Therefore, Mumbai has a jurisdiction. Part cause of action is in Mumbai. Therefore, Maharashtra, Mumbai High Court has the jurisdiction. SSC is there in the territorial jurisdiction of Gujarat within the boundary of physical boundary of Gujarat. And therefore, Gujarat High Court will also have jurisdiction because SSC is also affected by this action. However, if we apply the test of Supreme Court, then Mumbai is the only High Court which will have the jurisdiction. In my respectful opinion, that judgment was only with respect to deciding 127 read with 260 capital A. That is for the purpose of tax appeal and not for any other purpose. What if I file in a given situation, let's say in the same example, the jurisdiction is admittedly with Mumbai assessing officer. However, in the facts of the case, I file a tax appeal before the Gujarat High Court, citing that I am now in Gujarat. Gujarat High Court entertains that tax appeal and ultimately passes the order. Then, after that order is passed, the SSC realizes, because by now, large number of high courts have already taken a view based on Seth Banarasidas Gupta's judgment that wherever is the assessing authority, that High Court will have the jurisdiction. Now, Supreme Court says that original assessment order will decide the jurisdiction. Therefore, many High Courts would have now passed that order. So, what would be the remedy? If I go and tell the Gujarat High Court said that, sir, as per Supreme Court judgment, you never had the jurisdiction. And therefore, there is inherent lack of jurisdiction. And therefore, you could not have decided this appeal. It's only the Bombay High Court which can decide this appeal. And therefore, the interesting question would be that whether it is an inherent lack of jurisdiction or it is a lack of territorial jurisdiction, because both are different. Under Civil Procedure Code, section 21, it talks about two defects, a territorial jurisdiction and inherent jurisdiction. A lack of inherent jurisdiction is a non-curable defect. It cannot be cured at a later stage. So if authority does not have the jurisdiction, that is inherently authority is divorced of the jurisdiction, that jurisdiction cannot be conferred on that authority. Whereas territorial jurisdiction is a procedural aspect. And the law says that territorial jurisdiction or lack thereof has to be pointed out at the first available point in time. So the first available point in time is when you are arguing the tax appeal. And therefore, review would not lie against an authority which has already taken a view, believing that it has the territorial jurisdiction as well as the inherent jurisdiction. You cannot tell that authority afterwards that, sir, you do not have the territorial jurisdiction, because territorial jurisdiction has to be raised at the first available opportunity. Gujarat High Court in 2013, SCC Online 8991 took the view that such a dispute is falling within the confines of territorial jurisdiction. It is not an inherent lack of jurisdiction because High Court does have the jurisdiction. It is only which High Court would have the jurisdiction, and therefore it is only the territorial dispute. And therefore, once the tax appeal is heard, you cannot raise such a dispute. That's there is a lack of territorial jurisdiction. That cannot be done. The Gujarat High Court has passed a detailed order, and after taking into consideration all aspects of the matter, High Court laid down two principles. One, that High Court does have a power of review, and this kind of application can be entertained. And two, that High Court would not decide this issue after the hearing of the appeal. Therefore, territorial jurisdiction cannot be decided or cannot be raised after the appeal is heard. So all those decisions by various high courts across the country would not be disturbed because of the Supreme Court judgment. Another interesting issue that would arise would be that 127. I think I have already covered that. So that was one part, that is the Supreme Court judgment. We also have a Gujarat High Court judgment, which was shared with me by the convener. Therefore, we'll discuss that also very hurriedly under 127, because that is pertaining to 127. The judgment is 287 Taxman 504. Sir, judgments have already been circulated. Huh?
Yes, sir.
Okay, fine. So participants would have the judgment. Yes.
Yeah, we have circulated, but participant wants to know the Supreme Court judgment on 127 is PCIT versus ABC Papers Limited.
That's correct.
330. Yeah.
That is correct. And the second judgment, which is also under 127, is in the name of Kamlesh Rajnikant Shah versus PCIT 138 taxman.com 5959 Gujarat High Court judgment. Here the issue was with respect to transfer of jurisdiction from Ahmedabad to Mumbai. There was a search in Mumbai. In fact, there was a pan-India search, and everything was centralized at Mumbai. Because of the centralization, even the Ahmedabad SSC also got a notice from the Income Tax Department under 127 that, sir, we want to consolidate your assessments at Mumbai. And for that, the reason was that for the purpose of effective and coordinated investigation, the centralization is required. There was a show cause notice which was issued. SSC replied to the show cause notice, pointing out that, sir, we'll have a great amount of inconvenience coming all the way to Mumbai. We do not have any presence in Mumbai, and therefore this transfer from Ahmedabad to Mumbai is not reasonable. However, ultimately, the authorities took the view that for the purpose of effective and coordinated investigation, 127 transfer is required. In that process, the SSC challenged that order of transfer under 127 before the Gujarat High Court. Gujarat High Court ultimately upheld the decision of transfer and refused to intervene in the matter. However, in the process, Gujarat High Court laid down 2-3 principles of law which we are concerned with. The first principle of law is that is writing coordinated and effective investigation is sufficient reason or no. Gujarat High Court took the view, following the earlier judgment of Gujarat High Court in the case of Sriram Scrap, that in case of a search, the mention of coordinated and effective investigation is sufficient so as to justify the transfer of the case. There is no other reasons which are required to be given. The mere mention of coordinated and effective investigation is sufficient. Therefore, that phrase, the moment you find it in a notice and it's a search case, probably there are a large number of judgments which would take a view that such a phrase would give the justification for transfer. The second principle is, the High Court said that for the purpose of 127, there are 3 principles which would govern the law. First is the transfer must be in the public interest. Now, what is public interest is something which we have to discern from the general law. Public interest is basically coordinated and effective investigation is also considered as a public interest. The second principle is that before the transfer, opportunity of hearing must be given to the SSC, number 1. And number 2, that the authorities concerned must pass a reasoned and a speaking order so as to justify the transfer under 127. And the third principle is that if there are more than one principal commissioners having supervisory jurisdiction over transferor and transferee assessing officers, their consent is required, or the board will have to step into and ultimately justify the transfer. These are the three issues which are decided by the Gujarat High Court. Ultimately, Gujarat High Court upheld the order of the transfer. What is important and what is required to be remembered is that search and survey are two different actions. In case of search, probably effective and coordinated investigation is sufficient. However, in case of survey, such a phrase is not sufficient. Assessing authority has to demonstrate something more in order to justify 127 action. More so if the places are far away places. Gujarat High Court once again in another case, that is Hindustan Swaco Limited 241 Taxman 239, took the view that search and survey are not same. In case of survey, if the only reason which is given is coordinated and effective investigation, then that reason is not sufficient. For survey transfers under 127, assessing authority has to give some more justifications. That was a case where Baroda SSC was getting transferred to Kolkata, that is West Bengal, and SSC took a strong objection that this is merely a case of survey, and therefore coordinated and effective investigation is not sufficient. Gujarat High Court agreed that in such a case, 127 transfer is not justified. This will take care of 127 issues. If at all any questions are there, we can take it or we move forward.
No, you can move, sir. You can move, sir. No question.
Yes, sir. Right. Third judgment that we would discuss is serial number 3, that is 141 taxman.com 641. In the case of Principal CIT versus Khyati Realtor Private Limited. As they say, that bad facts lay down bad law and good facts lay down good law. This is a classic example that bad facts, or I would call it the lack of facts, the lack of factual foundation, can give rise to a judgment which is, I would say, not laying down the correct principle of law. However, the judgment has to be read in the peculiar facts of this case, because Supreme Court has devoted one paragraph saying that because in fact there was no justification for claim of such an expenditure, therefore court refused to grant any relief. And therefore at a later stage, as and when we have the correct case where we can bring on record the correct facts or the necessary facts, probably one can plead that this judgment is not applicable. The facts of the case were that we are concerned with assessment year 9-10. The assessee in question gave a sum of rupees 10 crore to one Messrs. C. Bansali Developers Private Limited. The case of the assessee before the assessing officer was that we have given this sum of rupees 10 crore for the purpose of acquisition of commercial premises 2 years prior to the assessment year in question. That is in sometime in 2007. SSC thereafter contended before the AO that, sir, the project did not materialize despite waiting for 2 years. And because there was no project which was visible, we made a request to that Bansali Builders to return the money back to us. Despite repeated reminders and requests, the money was not given back to us. And therefore, we have written off that amount as a bad debt for the year under consideration. This was the explanation given to the assessing authority. However, there was no booking agreement which was placed on record. There was no detail as regards when the project would take place, when the deliveries would be made, how many units are required to be purchased, what are the details of those units. None of those details are placed on record. Ultimately, assessing authority held against the SSE on the ground that, sir, you do not fulfill the basic requirement of bad debt 3617. The basic requirement is that you must have written off this amount in the books of accounts. To that extent, there is no controversy. SSE wrote off that amount in the books of accounts. However, the another important condition is that the amount in question must have been offered as income in the earlier year or in the same year. So therefore, if you are writing off a particular amount, that amount should have been offered as income in the earlier assessment year or in the year in question, so as to entitle you to claim it as a bad debt. In the facts of this case, there was no offering of income at any stage, and therefore that condition was not fulfilled. SSE took the stand before the authority that, sir, maybe we have not offered any income on account of this transaction. However, we are governed by 36(2), subclause 2. 36(2) says that in case of a money lending business, that is in case of advance which is given in the ordinary course of money lending, even if there is no income which is offered for tax, you can still claim it as an allowable deduction. Assessing authority refused to go with that submission, ultimately disallowed the claim of deduction. The matter was carried before the CIT appeal. CIT appeal also ultimately held against the SSE and refused to grant any relief under section 36(1)(7). The matter reached the tribunal. Tribunal allowed the appeal of the SSE and held that this is allowable as an amount under 36(1)(7). High Court dismissed the appeal of the department on the ground that tribunal has passed a reasoned order and there is no substantial question of law which is there in the order of which is arising from the order of the tribunal. The revenue reached the Supreme Court, and before the Supreme Court, the case was that, sir, the basic conditions of 36(1)(7) is not fulfilled, and therefore this is a case where both the authorities, that is ITAT as well as the High Court, are wrong in granting this particular allowance to the SSE. The submission before the Supreme Court was on the part of the SSE is that, sir, the SSE was in the business of real estate and financing. Both the business were being carried on by the SSE. For that purpose, a memorandum and the association of the SSE was placed before the Supreme Court to justify that both these objects, that is a real estate business as well as the financing business, are within the falling within the object clause of the company. It was also pleaded that this amount of 10 crore was given to one Bhanusali Builders for the purpose of acquisition of one premises. However, that did not materialize, and ultimately we have to write this amount off. The writing off took place in 9/10. Therefore, to that extent, conditions are satisfied. And the last submission was that this amount of 10 crore was granted to Bhanusali in the ordinary course of his business. However, the SSE did not say that in the ordinary course of its money lending business, because there was nothing on record which would justify that this was given in the ordinary course of its money lending business. In fact, Supreme Court has noted that though the SSE in question received certain interest income, however, it was unable to just the link that such an interest income has come out of this advance. And therefore, ultimately, this was the submission of the SSE before the Supreme Court. Revenue Authority submission was that basic conditions are not satisfied, and therefore 36(1)(7) cannot be claimed. Supreme Court agreed with the submission of the revenue authorities. And in my opinion, also, this is not a case where one can claim deduction under 36(1)(7), because the basic condition that income must have been offered for tax in this year or earlier year is pure and simple not getting satisfied. Amount is given, written off, no dispute on that score. However, this was an amount which was given as by way of advance for the purpose of purchase of property, and therefore that cannot be treated as a debt in the sense of 36(1)(7), because it cannot be treated as a debt in that sense. It cannot be claimed as a bad debt. Supreme Court ultimately held that for want of income having been offered on this transaction, you are not satisfying the condition, and therefore the view was taken against the SSE. Thereafter, Supreme Court has discussed the law on the issue that after 1/4/1989, even if you make a book entry, that is sufficient, no dispute on that score. Provision is not allowable, no dispute on that score. 36(1)(7) basic conditions are not satisfied. Again, there was no dispute on that score. In paragraph 18 of the order, Supreme Court mentioned that basic facts are not justifying this claim of allowance at all. There was no details as regards what was the unit which was booked, what is the delivery date, what are the payment terms, what is the duration, and other terms and conditions Nothing of that sort was mentioned. Insofar as the loan transaction was concerned, there was not even mention as regards what is the interest which is going to be charged and in what manner. There was nothing of that sort which was pleaded or which was there factually on record before the Supreme Court. Supreme Court said that for want of all these details, it cannot be allowed as a bad debt. Insofar as the alternate argument that, sir, if not bad debt, you kindly allow this as an expenditure under section 37. Supreme Court has again gone back to the basics. Supreme Court said that for the purpose of 37, there are few conditions which are required to be satisfied. That it has to be wholly and exclusively for the purpose of business, must not be in the nature of personal expenditure, must not be in the nature of capital expenditure. And that is where Supreme Court has caught the SSE. Supreme Court was of the view that under 37, if you want to claim, then you have to demonstrate that this was a capital expenditure, not a capital expenditure. This was a revenue expenditure. SSE in the facts of this case, having failed in establishing that this was a revenue expenditure, Supreme Court refused to intervene. Supreme Court followed the old judgment of Mysore Sugar. Mysore Sugar was an interesting case. A sugar mill gave large number of advance to various farmers for the purpose of, in anticipation that as and when they grow the crop of sugarcane, they will buy the sugarcane and adjust that money which was advanced to them. However, rain god has a different plans, and in that year there was a drought, there was no rains, and therefore the farmers were severely hit, and there was no crop of sugarcane in that region. Because of that, the Mysore Sugar Company has to write off all these advances which were given to the farmers. The question that arose was that whether it can be claimed as an allowable expenditure under 37 or no. Supreme Court, after analyzing the law on the issue, took the view that that advance was on a revenue account because it was advance for the purchase of raw material. Sugarcane being a raw material for Mysore Sugar Company, it was an advance on the revenue account. It is available as an expenditure under section 37 of the Act. And ultimately, issue was decided in favor. However, in the facts of this case, Supreme Court noted that money was given for the purpose of purchase of a property. If the money was given for the purpose of purchase of a property, therefore it is on account of a capital head, and therefore this cannot be even available as an allowable expenditure under section 37. Lastly, Supreme Court has also said that, sir, if a 37 would come to your rescue, provided it is not falling within 30 to 36, because 37 is a residuary provision. 37 can come to your rescue provided it is not, the expenditure in question is not contemplated under 30 to 36. Supreme Court said that this expenditure is specifically contemplated under 36(1)(7). And if it is specifically contemplated under 36(1)(7), and for want of fulfilling the conditions of 36(1)(7), we are denying you, you cannot then fall back on the residuary section. And therefore, you can't even claim it as an expenditure under 37. So on both the counts, the expenditure in question being a capital expenditure, as well as the expenditure is already covered under 36(1)(7), we deny you the relief under 37. Now, what the issues? What are the issues which are likely to arise? The issue number one is that what if I demonstrate that I'm in the business of buying and selling commercial properties for which the advance was given? What if I can demonstrate that this was an advance for the purpose of acquiring stock in trade? Because here such an exercise was not done. Unfortunately, it was, the facts were not available on record. However, what if would the situation differ if I can establish that this was my stock in trade? The commercial property in question was going to be my stock in trade. My opinion, if one can demonstrate that this was going to be an acquisition on a revenue account, and I'm in the business of buying and selling of properties, and this was for the purpose of acquiring stock in trade, Mysore Sugar would squarely apply, and I can certainly claim this expenditure under 37, subject to again other aspects of the matter. Therefore, one cannot say that 37 door is closed for all times to come. Supreme Court itself has said that had this transaction been on revenue account, probably 37 could have come to the rescue of the SSC. The second aspect of the matter, which I believe that once we go through the judgment, we realize that the aspect as regards section 28 small Roman 1 loss has not been claimed or has not been raised as an argument before the Supreme Court. All of us are aware that there are certain losses which can straightway be claimed under section 28. We know the distinction between loss and expenditure. Both the terms are different. 37 contemplates expenditure. And for that, there are a large number of conditions. 37 does not deal with loss. For the purpose of loss, we have to go back to the basic. Namely, 28 would say that your business income is going to be computed based on the following sections. And for the purpose of business income, one will have to find out what are the gross receipts less allowable expenditure. So these losses, one would generally claim under the provisions of section 28. Such an argument was not there. And therefore, if let's say if we have to raise that argument before the Supreme Court, had the SSC raised that argument of 28, what would have been the situation? Because under 28, the test is that it has to be a loss, because loss and expenditure, the distinction has been explained by Supreme Court in T.A. Qureshi's case, 287 ITR 547, as well as the Woodward's case, 312 ITR 254. In both the cases, Supreme Court explained that expenditure is something which we spend out of our pockets. It is a spending of some money which would give rise to expenditure, whereas loss is usually the difference between two figures, and that is suffered during the course of the carrying on of the business. So the 28 condition, section 28 condition is that such a loss must have a close and proximate nexus with the carrying on of the ordinary business activity of an SSA. So whether can we say that my ordinary activity was one of buying properties? If I can demonstrate that this was done during my ordinary course of business activities, can I claim that as an allowable expenditure? I personally believe that we have large number of judgments wherein section 28 loss is allowed as a revenue expenditure. Judgment of the lead judgment of the Mumbai High Court in the case of Lord's Dairy Farm, 27 ITR 700, Gujarat High Court 136 ITR 825, Abdul Razak's case. And there are large number of other Supreme Court judgments taking a view that such a loss is allowable under section provisions of section 28. And therefore, probably 28 argument is not yet answered by the Supreme Court, and even 37 argument is kept open if one can demonstrate that this was nothing but a revenue expenditure. Therefore, in my humble opinion, this is a judgment which is based entirely on the peculiar facts of this case, where there were hardly any factual information available, very scanty facts, and therefore that has ultimately led to a judgment which is completely undesirable. Can we move on to the next one?
But this will be capital loss if at all, no, sir? Because he was not into the business of buying and selling. It will be a capital loss, not
Yes.
under 28. It will not
Right.
be under 28.
Neither under 37 nor under 28.
Yeah.
Right.
You are saying in other cases, if it is during the course of business, that loss.
Yes. But then, no, sir, 28, there is no concept of revenue versus capital. Kindly appreciate the concept of capital versus revenue would come under 37, because 37, the section specifically says that not in the nature of a capital expenditure. Whereas 28, we can certainly take the case of Nainital Bank or Badri Prasad Daga, all those cases where the monies are looted, where the loss is suffered, where the monies are given as a part of business activity. Then those can be claimed, irrespective of the fact whether it is capital or revenue, can be claimed as a business loss.
Right.
And therefore, one can still plead its case under 28, divorce the capital revenue control. If it is a revenue, we can straightway go under 37 as held by Supreme Court itself. If it is, let's say, capital account, amount is given for the purpose of purchase of that office premise or commercial premise, Then also, the moment I demonstrate that, sir, this was part of my overall business activity. I wanted to open an office over there. Let's say I wanted to sit there and run my business from that office. Then can I not claim it as an incidental loss, which is arising by carrying on the business activity? That is the question.
Right. Sir, here request is that you can take first the 148 case laws, because they know that you have in-depth knowledge on that. They have also heard you in Gujarat High Court, where you have interviewed and explained the whole provisions in great detail.
Right,
so
sir.
that request is there from my friends.
Let us look at the judgment of the Delhi High Court. Touchstone. Touchstone. Yes. Let us pick up. Yes. Let us pick up Touchstone.
Yeah.
Touchstone, Delhi High Court judgment. If you look at the judgment, the earlier part deals with the merits of the matter. Probably we can skip the merits of the matter, because I understand that is not what is troubling everyone. What is troubling everyone is the law which is laid down by Touchstone, to the effect that the ground of limitation cannot be argued for assessment year 13-14, and obviously if not for 13-14, 14-15 also. Touchstone was a case where reopening took place. Original notice was issued on 29th June 2021. The original notice under the old scheme was issued on 29th June 2021 for assessment year 13-14. The notice in question was challenged before the Delhi High Court. Delhi High Court disposed of, by way of a consolidated common order, large number of writ petitions, including the writ petition of Touchstone. Delhi High Court held that though the notification is valid, however, the notice in question was not valid. The entire bunch was taken before the Supreme Court. Supreme Court, in the case of Ashish Agrawal, took the view that all those notices which were issued from 1/4/2021 and 30th June 2021, they were all issued under the old scheme, which is admittedly not permissible. Supreme Court also said that you treat those notices as notices having been issued under the new scheme, as a show cause notice under 148 capital A small b notices. Supreme Court also said, as item Roman 4, that all the issues, including the issue of limitation, is open to the SSE to argue before the appropriate authority. Based on this, matters were sent back to the file of the respective assessing authorities. Those assessing authorities, as per the Supreme Court guidelines, gave certain more information, called for the reply of the SSEs. Once the reply was received, passed the order under 148 capital A small d. In the facts of this case also, such an order was passed, and pursuant to that order, as a consequence to that order, a fresh 148 notice was issued on 22nd July 2022. On 22nd July 2022 notice is something which is subject matter of the writ petition. The case before the SSE was that it has acquired certain shares at below the market price, and therefore provisions of section 56 would apply. And therefore, for the purpose of application of 56, let's say a share worth rupees 1000 is acquired by the SSE at rupees 100. Therefore, 900 rupee would become the income under 56. And that income is as escape assessment. And therefore, that was required to be taxed in the hand of the Touchstone. Now, that 148 notice came to be challenged before the court. There were arguments which were raised. We are not frankly concerned with the other arguments. We are more concerned with the argument as regards the limitation, because that is going to hurt all of us. From paragraph 13 onwards, the court started discussing the issue as regards how the limitation aspect is required to be gone into. In paragraph 13, the court says that we reproduce the original, that is the old 149 provisions. We find that 149 provisions are up to 4 years and up to 6 years. Two slabs are there. After that, the court also takes notice of the TOLA Act, Taxation and Other Laws Amendment Act. TOLA Act, according to the court, has extended the limitation when it is read with notification 20 and 38 of 2021. So according to the Delhi High Court, the limitation period under the old act, under old 149, got extended up to 30th June 2021. Now, if the limitation period under the old act was extended up to 30th June 2021, and if the notice is issued on 29th June 2021, according to Delhi High Court, such a notice was a notice which was well within the limitation period. Now, if that notice was within the limitation period, the court was of the view that the first proviso to the present 149 cannot come to your rescue. On page 9 of the order, the court reproduces the present 149. Highlighted portion is the proviso. The court is of the view that the proviso, which reads like this, let me read the proviso so as to put across the point. Provided that no notice under 148 shall be issued at any time in a case for relevant assessment year beginning on or before 1st day of April 2021, if such notice could not have been issued at that time on account of being beyond the time limit specified under the provisions of clause B of subsection 1 of this section as they stood immediately before the commencement of the Finance Act 2021. So the test is that could the authorities have issued the notice on or before 1st day of April 2021? The court asked that question to the council. Ultimately, court said that the authorities could have issued such a notice before 1st April 2021, even for 13-14 as well as 14-15, because 13-14, 14-15 time limit of 6 years expired insofar as 13-14 on 31st March 2020, 14-15 on 31st March 2021. However, the time limit which expired on 2020 March 2020 got extended up to 30th June 2021 by virtue of various remedial measures. Therefore, court held that such a notice could have been issued under the old provision, and therefore first proviso cannot come to your rescue under the new act, and therefore your argument that limitation is expired is not correct. This is broadly the issue which was decided by the Delhi High Court. The crux is that under the old provisions, notice having been issued in time, now you cannot re-agitate and say that, sir, you apply the first proviso and hold that such a notice could not have been issued. Now, why do I say and why do I believe that Delhi High Court judgment probably has not laid down the correct law? Look, the first and foremost thing is, if the issue is so simple, because remember one thing, that before Honorable the Supreme Court, all the notices were between 1st April and 30th June 2021. Because that was precisely the issue which was there before the Supreme Court. Not a single notice was prior to 1st April 2021. Not a single notice was after 30th June 2021. Supreme Court was only concerned with this quarter, the first quarter of financial year 2021-22. If the notices could have been issued and if the notices were in time as held by Honorable the Delhi High Court, there was no occasion for the Supreme Court to hold that all the defenses, including the defense of limitation, is available to the SSEs. Because this was the only reopening which has gone before the Honorable the Supreme Court. There was not any year prior to 13-14 which went to the Supreme Court, because April 21 and June 21 only 13-14 could have been issued. The notice for 13 prior to any year prior to 13-14 could not have been issued even with the help of TOLA between 1st April and 30th June 2021. So the only years which were there before the Supreme Court were 13-14 onwards, remaining years. Therefore, there was, if the issue was that simple, that the issue of limitation has expired and that issue cannot now be agitated because original notices were issued in time, then the Supreme Court's observation that all defenses which may be available to the SSC, including those available under Section 149 of the IT Act, and all rights and contentions which may be available to the concerned SSC and revenue under the Finance Act 2021 and in law shall continue to be available. These are the specific words of the Supreme Court. And therefore, if I read this, the one thing is clear, that the issue of limitation has not been answered by the Supreme Court at all. It is all left open. And therefore, Delhi High Court, on the ground that Supreme Court having accepted the submission of the revenue, that these are all the notices which are valid notices, and therefore it has sent back to the authorities for the purpose of initiating proceedings under 148 capital A small b, itself is not correct. The second argument, the old law 147, 148 as well as 149, they all got discontinued on 31st March 2021, admittedly, because if they would have continued for the up to 30th June 2021, probably Supreme Court would have reversed the judgments of the High Courts and settled the issue there and then only. Supreme Court was conscious, and Supreme Court has held that 1st April 2021 onwards, only the new regime, the new provisions will apply. Old provisions have no right or has no legal sanctity to continue. Therefore, old provisions expired on 31st March 2021, admittedly. If the provisions have expired, the question would be that can the notices under the expired provision be issued beyond the time limit? Answer is obviously no, because the provisions itself are restricted up to 31st March. You cannot issue any notices beyond 31st March. Therefore, notices have to be held to have been issued only under the new provision. If the notices are issued under the new provision, we'll have to read the new provision. When we read the new provision, we have to read even the proviso to 149 also, because we cannot read the new provision in isolation. Now, when we read the proviso, the Parliament's intention is very clear that the litigation or the right to litigate, right to issue notice, which has already expired, the right which has accrued in favor of the SSC and against the revenue, cannot be revived because a larger limitation period is available under the new 149. New 149, we are all aware that it can be reopened right up to 10 years. Now that larger period is not available where the issuance of notice has already expired under the old regime. Old regime has expired on 31st March 2021. Along with that, right to litigate has also expired. And therefore, those years, namely 13, 14, 14, 15, those years have already expired. The remedial measures, namely the notices for those years, could not have been issued without crossing the hurdle of the first proviso to 149. Therefore, the next question is that whether 149 first proviso has to be read so as to extend the time period as provided under TOLA. Because ultimately, Delhi High Court, if Delhi High Court is correct in its interpretation, then even when reading the first proviso to 149, the present 149, we have to read the extended limitation period into that proviso so as to give that extension for the purpose of issuance of all these notices. In my view, TOLA did not extend any time limit under the new regime. TOLA extended the time limit only under the old regime. Old regime has expired on 31st March. Therefore, the elephant is already not there. However, the tail has remained. The revenue wants to read that though the right to take action under the old regime has expired on 31st March. However, without old regime, we would still continue to hold on to provisions of TOLA so as to get a 3 months extension, which we want to now read into the new proviso, so as to extend the time limit for the purpose of issuance of notice, and that too under the new regime. Look, the basic fundamental flow is that this is not a continuation of the old proceedings. This is a fresh proceeding. The only thing which the Supreme Court has done is that instead of reading the reasons as well as the old notice under 148, quashing them, Supreme Court converted that merely into 148 capital A small b notices. Those are only the show cause notices. The show cause notice ultimately has to be converted into the final order under clause D, and only thereafter a notice under 148 can be issued. These are admittedly fresh proceedings. Law says that 149 says that the time taken for the purpose of issuance of notice under small b, eliciting response of the SSE under small c, and passing of order under small d of 148 capital A is required to be excluded from the limitation period. That once we exclude that, then the notices which are issued today are all considered as having been issued under the old regime, that is under after 1st April before 30th of June. That is all that is happening. These are all fresh proceedings. They are not continuation of the old 148 proceedings. Those proceedings have died on 31st March 2021. These are new proceedings, and the only exception to that proceeding is Supreme Court said that instead of issuing fresh notices under 148A small b, you consider the old notice as a fresh notices. That is all that has happened. And therefore, once we consider this as a fresh proceedings, we have to apply the first proviso as it is. First proviso, there is no extension under TOLA, and therefore there is no question of Delhi High Court laying down something which is contrary to the Supreme Court judgment. And interestingly, if you look at the notifications, both the notifications, you would find notification number 20 as well as notification number 38. Look at the notification. Allow me to read only the explanation. Listen to the explanation very carefully, because identical explanation is there in both the notification. What the explanation says is that this notification has the impact of extending only the old provision. It has no application to any new law which is being laid down by Finance Act 2021. In fact, that is specifically excluded. Therefore, we cannot read any extension into the new provisions, more particularly the proviso to the new provision. Listen to me. Explanation, which is common in both the notification. Explanation says this: for the removal of doubts, it is hereby clarified that for the purpose of issuance of notice under 148 as per time limit specified in section 149 or sanction under 151 of the Income Tax Act, under this subclause, the provisions of section 148, section 149, section 151 of the Income Tax Act, as the case may be, as they stood as on the 31st day of March 2021, before the commencement of the Finance Act 2021, shall apply. So, for the removal of doubt, it is clarified that for the purpose of issuance of notice under 148, time limit under 149, you apply the old law and not the new law. Therefore, what is extended is the old law. Now, that extension itself is held to be illegal by the Supreme Court. Supreme Court said that you can't extend something which has expired on 31st March. If extension is legal, then there was no question of sending the matter back to the file of the various assessing authority, because extension is legal. Then there is no, all those notices are legal. However, Supreme Court does not say that. Supreme Court says that notices are not legal. Old provision must die. However, in order to save the skin of the revenue, you consider old notices as having been issued under the new notice, under the new scheme. Therefore, Delhi High Court, in my respectful submission, did not appreciate the controversy in the correct perspective. It has completely lost sight of the fact that Ashish Agrawal has kept the issue of limitation open. Once the old scheme dies, you cannot apply the extension in isolation. Without the scheme, you cannot have extension. You need the basic act, the basic time limits, basic limitation period so that you can extend it. You can't only have extension provision without there being the basic law. Therefore, my humble opinion, touchstone does not lay down the correct law. Even after touchstone, there are large number of high courts which are still admitting the appeals on the ground of limitation for 13, 14, 14, 15, and they are all prima facie of the view that 13, 14, 14, 15 are beyond the limitation period, and therefore that cannot, the touchstone criteria cannot apply to those decisions.
Punjab and Haryana High Court has held in favor also, I am told.
Yes.
In one of the judgment. Yeah.
Punjab Haryana is with respect to the notification which was issued after the Supreme Court judgment, wherein the CBDT says that below 50 lakhs, 13, 14, 14, 15 limitation would apply. However, above 50 lakhs, that limitation will not apply. So the SSE over there challenged that notification itself rather than challenging the individual notices, and Punjab and Haryana has passed an interim order admitting the petition and staying the proceedings for that year. So very notification is subject matter of challenge before Punjab and Haryana High Court. Gujarat has admitted large number of writs. Bombay also, I am told, that has admitted 13, 14, 14, 15. So we await the outcome of all this. But then issue which is decided by the Delhi High Court is, in my respectful opinion, it's not the correct interpretation of the law on the issue. The basic fallacy in the High Court order is High Court first decided that the notices are in time, and thereafter every time the question was raised, High Court itself answered that notices are in time, therefore this argument is not available to you. However, the basic fallacy, fundamental fault in the High Court's judgment is that notices itself are not in time.
To the 127 cases which we discussed initially, and one relating to this reassessment which we discussed just now. Now, we discussed that the defect of jurisdiction cannot be cured. But in 124(3), it is provided that if the jurisdiction is not challenged within 1 month of the issue of the notice under 142(1) or 143(2), or before the completion of assessment, then thereafter the jurisdiction cannot be challenged. So now, where is the reconciliation? I mean, what is the effect of 124(3), and what is the effect of is that the jurisdictional defect is not curable? Okay,
these are all for income tax authorities. You cannot challenge the jurisdiction of the assessing office. What we were discussing, that Supreme Court order as well as the Gujarat High Court order, what we were trying to discuss was that which High Court will have jurisdiction. So it's High Court is not an income tax authority. High Court's jurisdiction would flow from reading of 260 capital A, 269 and the provisions of Constitution of India. Therefore, 124 is AO's authority. We are not challenging the AO's authority insofar as 127 inherent lack of jurisdiction, the concept which I discussed with you. That was vis-a-vis the jurisdiction of the High Court. So the High Court jurisdiction is once a High Court decides an appeal under sitting as an appellate court under 260 capital A. Once that decision is made, then you cannot turn around and say that, sir, you never had the jurisdiction, because as per this law, the law which is laid down by the Supreme Court, jurisdiction lies with the High Court, where the assessing officer has passed the original order. That is something which is not permissible, because ultimately it's a dispute as regards territorial jurisdiction and not as regards inherent jurisdiction.
Okay, so as far as the assessing officer is concerned, supposing a wrong assessing officer has assumed the jurisdiction, passed the order, and if I have not challenged within the time limits which is given in 124(3), then I cannot challenge it later on?
No, apparently you cannot, except probably, let's say, take an example, assessment, you had multiple opportunities, you choose not to raise that dispute, therefore you cannot challenge that at a later stage. However, let us assume that a 148 notice is issued. It's that 148 notice is issued by a non-jurisdictional assessing officer.
Correct.
A non-jurisdictional assessing officer issuing the assessment of the reopening notices. You file the return of income within a period of 30 days, let's say, hypothetically. Correct. And then you realize, after having filed the return of income, that he is not my assessing officer. My assessing officer is someone else. And as per the language of the section, it's only the assessing officer who can issue notice under 148. no other authority has any right to issue any notice under 148. Can you then challenge it? Then the answer is that yes, you can challenge it, because 124 talks about the procedure. Here you are talking about the jurisdiction, the very authority to issue the notice in question. So there you can file a writ petition saying that, sir, my filing of return cannot be treated as an acquiescence or a consent to confer jurisdiction which he never possessed.
But that I can challenge even before the assessing officer also within the time limit of 124.
Of course, you can challenge.
Okay.
You can challenge.
Now the question relating to reassessment is like this. As you mentioned that the Supreme Court in Ashish Agarwal has accepted that from 1st of April 2021, the new law is prevalent.
Right.
And Supreme Court was concerned with the notices issued between 1st April 2021 and 30th June 21. So Supreme Court was not concerned with the notices issued earlier. Now the question is that supposing the notice was issued by 31st of March 2021 and assessment proceedings reassessment proceedings are concluded during financial year 21-22 after June. So can one say that from 1st of April 2021 there is a new law? So then that new law is to be applied in its entirety right from the issuance of the notice till the completion of assessment. And though the notice was issued prior to 1st April 2021, but now the assessment is concluded and this assessment is without following the new procedure, say 151 approval or say 148D order. Can one challenge in that fashion that now if so the assessment which has been done in the new era after the new should have been completed in entirety following the new procedure?
No, admittedly, notice is issued prior to 31st March, right? And served also prior to 31st March.
Correct.
Issued and served both.
Absolutely.
Right. Then you cannot, because then you are governed by, these are all procedural aspects. Once the procedure has commenced, you look at the law which was prevalent on that point in time, on that date. So if the notice is issued prior to 31st March, you have to consider the law as on prior to 31st March. Once proceedings are validly initiated, you cannot turn around after and say that, sir, now the procedure has undergone a change. Therefore, then because courts have taken the view that even the appellate proceedings are continuation of appeal proceedings, the appeal proceedings are also continuation of assessment proceedings, then one can also say that even pending appeals, there we can raise this issue. Therefore, the law is now well settled that all procedural aspects, you have to consider the law the day on which procedures are initiated.
Okay.
Right.
Gujarat High Court judgment, Gujarat High Court, where you were arguing as an intervener, explained the whole law. What is the outcome of that judgment, sir?
Which one?
One judgment, Gujarat High Court, which was telecast also, and you have explained the whole law on that 148A. What is the outcome of that judgment?
Sir, that was in fact not the matter which was going on. The Honorable Court wanted to know the new proceedings. So it was, I was just without any matter, I was trying to explain the new procedure to the court.
Okay.
Thereafter, no, in fact, thereafter, court has admitted large number of more than few hundred matters are admitted on various issues, including 13, 14, 14, 15. The matter is not concluded yet. Arguments are required. They are still pending.
Okay, so you can take the next case.
Yes.
Thank you very much, sir. Thank you.
Pleasure. I think we are almost. We can take one more judgment. I think what I can do is I can
extend 10-15 minutes also, sir. If you don't.
What I do is
because it is going so well. Yeah.
Yes. What we can do is we can hurriedly go through the remaining judgments, try to understand the finer points. I may not discuss the judgments in detail. I would request the participant to read the judgments, and thereafter I'll only discuss the nitty-gritties of those judgments.
Yeah, right.
The next judgment is with respect to Delhi High Court, PCIT versus BMO Advisors Private Limited. It's with respect to 48(2)(b), the concept of 48(2)(b), whether bonus given to the director are within the ambits of 48(2)(b), and whether payment of bonus is prohibited when it comes to paying the directors of the company. In that context, Honorable the Court was called upon to decide the issue. The court has laid down two important principles. Principle number one is that when deciding a tax appeal, though the principles of res judicata are not strictly applicable, however, there is a law of consistency. So in case, if in your own case for earlier years, if a particular view is taken by the authority, then the law of consistency demands that that view must be consistently followed. You cannot turn around and say that now I have a different version, or I have become wiser and I want to decide the issue in a different manner. So therefore, Supreme Court, the Honorable Delhi High Court laid down a very important rule as regards consistency. In fact, Supreme Court in the case of Excel Industries, which is referred to by the Delhi High Court, 358 ITR 295, very categorically held that the law of consistency is required to be respected, even if the principle of res judicata is not technically applicable and each assessment here is a separate assessment here. However, the view is that if at all an issue is already decided, then unless there are substantial change in the facts, you cannot take a diametrically opposite position. The second principle which is laid down by the court is that bonus, etc., is governed by 36(1)(2). 36(1)(2), it says that bonuses, etc., are allowable only if it is paid to an employee. The only proviso is that it is not allowable if they are paid in lieu of profits or dividend. So if a person is otherwise entitled to profits and or dividend, then that person is not entitled to receive the bonus, because bonus cannot be paid as a substitute to the dividends and or profits. However, in case of a limited company, a director is not entitled to profits or dividend unless he is a shareholder. And even if a shareholder is there, then there are large number of shareholders, therefore the ratio would differ. Courts have said that under such a circumstances, bonus cannot be denied. The payment of bonus cannot be denied in the hands of the company as an allowable expenditure. Also, as a passing reference, Honorable the court has held that 48(2)(b), you have to consider the market price. Look, anything which is unreasonable can be disallowed under 48(2)(b). Now, what is unreasonable? That burden is on the revenue. So it is the revenue authorities who have to ultimately establish that this is unreasonable. It is not a burden of the SSC. So if the revenue authorities say that bonus is very exorbitant, very high, they have to bring on record the comparable instances. They have to bring on record and establish that this is something which is unreasonable if they want to invoke the provisions of 48(2)(b). Now that burden is also not discharged in the facts of that case. So we move on to the next judgment. Next two judgments are on the same line. Decision as regards the treatment of various subsidies received by an SSC, whether they are to be treated as a capital receipt or they are to be treated as a revenue receipt. Judgment of Himachal Pradesh High Court, HP Nursing Registration Council versus PCIT, and the judgment of Rajkot Tribunal, Gujarat State Lion Conservation Society versus CIT. Both these judgments are on the treatment of the subsidy. Mind you, there is a subsidy law which has now undergone a change. There is an amendment in section 224(18), small Roman 18, with effect from 1/4/2016, wherein they say that any kind of subsidy, by whatever may be the nomenclature and whatever may be the object, everything would become income. There are only two exceptions. One is if at all the subsidy is already used for the purpose of reducing the actual cost as contemplated under explanation 10 to 43(1). That subsidy cannot be treated as a revenue receipt. And second exception is that if it is direction, the subsidy is given with a direction to form part of the corpus of that particular entity, then that subsidy cannot be treated as a revenue receipt. Other than both this, all subsidies would be treated as a revenue receipt. The facts of the case in this case was that Himachal Pradesh, this institution for the purpose of Himachal Pradesh Nursing Registration Council Act established this institution for the purpose of educating and preparing the nurses in the state of Himachal Pradesh. This was done under a statutory act, and because it was a 100% government entity, it was being funded by the government authority. That funding came by way of a subsidy in the hands of the recipient, the SSE. And the question arose as regards the treatment of that subsidy in the hands of the SSE. The Himachal Pradesh High Court decided the issue in favor of the SSE by holding that this was a subsidy which has the object of establishing the institution. It is not a subsidy which is given so as to increase the profitability or increase the revenue receipts. And the principles of law laid down by the Supreme Court in the case of Sahani Steel and Ponni Sugars were applied. And the view that was taken was that if the object of the subsidy is a subsidy which is for the purpose of strengthening the existence of the institution, or a subsidy which is given for establishing a particular institution, then that is on the capital account, and that receipt cannot be taxed as a revenue receipt. Whereas if the subsidy is given to the SSE to enable to run its business more efficiently, more profitability, then that receipt has to be decided as a revenue receipt in the hands of the SSE. However, after 1/4/2016, after the amendment in 224/18, I have not come across a single judgment wherein the view that is taken is that even after the amendment, the subsidies can still be considered as a revenue receipt. Because after the amendment, probably the position of law has become crystal clear. Insofar as Rajkot Tribunal judgment is concerned, though it is on 263, more on 263, and the powers of the commissioner, it has also decided the issue on the same lines, that the money which was given to that Gujarat Lion Conservation Society was for the purpose of laying fencing across the railway lines so that the lions' lives can be saved. And that money was utilized for the purpose of ultimately creation of that barrier across running parallel to the railway tracks. Tribunal took the view that such a subsidy is nothing but a grant which is capital on account, which is a capital account transaction, and therefore that cannot be treated as a revenue receipt, and therefore 263 jurisdiction, assumption of jurisdiction, is not correct. Interesting issue is that can 263 be initiated at the instance of the assessing authority? Tribunal has decided the law in favor of the SSE that if the initiation of 263 by the commissioner is at the instance of the assessing authority. In the facts of this case, AO wrote a letter to the commissioner that, sir, I believe that there is some revenue leakage and therefore you kindly initiate 263 proceedings. Tribunal said that such a 263 order is not maintainable in the eye of law. The assumption of power under 263 is only if the commissioner finds some error and that error is causing prejudice, not when the assessing officer points out such an error to the commissioner. So these two.
In this Gujarat state, I think they have said it is a income.
Yes.
And 15% deduction is allowed.
No, in fact, here the commissioner was of the view that the grant of subsidy, yes, grant of subsidy ultimately is something which is a liability, a certain liability. Kindly look at page number 3, that it is a liability. In fact, if it is a liability, the question of application would not arise, because application would arise only if it is an income.
Yeah.
It is, in fact, on that short ground itself, the tribunal would have held in favor of the SSE that if the commissioner is of the view that such a receipt in the hands of the SSE is a liability, if it is a liability, it can never become income. If it is not income, there is no question of 11(1) setting aside accumulation. 11(1) would not arise because income would not be there.
Sir, it as a SSE had been receiving government grants in earlier years as well as and revenue had accepted same as income assessable, yes, eligible for accumulation.
Yes, sir.
Here
therefore, rule of I agree with you, sir, that consistency rule is applied, and in the earlier year it was held that the same amount of income was already offered for tax with accumulation. Therefore, this is accepted. However, I am pointing out something different. Kindly see page number 3, third line from the top of the judgment, very judgment.
Yes, sir.
What is the commissioner's objection? Commissioner said that thereafter principal CIT issued 263 on the ground that SSE during the impugnure has received government grant amounting to so and so from the state governments. since grant received from the government are only as ascertained liability of the government, they cannot be treated either as a voluntary contribution or income from property held for charitable purposes covered under 11.1 and 11.2 of the Act. So his objection is that this is not an income. This is a liability. You have received a loan. So if it is a liability, there cannot be any income in my hand. If there is no income, there is no question of 11.1 or 11.2 for that matter. If there is no 11.1 or 2 matter, the commissioner itself is wrong.
That was commissioner's objection.
Yes.
But then tribunal held it is an income.
Yes.
And as in the past, we will allow 15%.
Yes.
The educational institutions also, they are receiving salary grants. Similar issue arises there.
Right.
So this is a judgment which says that 15% should be allowed.
15% should be allowed, but however, provided it is an income. If you are treating it as an income, then obviously accumulation, including 11.2, even you can set aside a part of that accumulation for trustee's object.
Right, sir.
Bombay High Court judgment next is Perizad, Zorabian, Irani on the issue as regards if you are getting only remuneration, interest or any amount which is contemplated under 28(5), small Roman 5, and you are showing it as a business income, are you required to get your accounts audited? The High Court said that requirement of auditing the account under 44AB would arise if you are carrying on a business activity. You are admittedly not carrying on any business activity. Here it is as a partner, you are receiving this money. The business activities are being carried on by the partnership firm, and therefore you are not responsible to get your accounts audited. In fact, if you look at the opening words of 44AB, you would find that every person carrying on the business has to get the accounts audited. Now here, person is admittedly not carrying on the business. It is only receiving the passive income under 28(5), which is taxed as a business income by way of a living fiction, which is created under 28(5). Other than that, there is no finding that the SSE was carrying on any business, and therefore High Court said that once you are not carrying on any business, in fact, you are carrying on a profession falling under clause B. Therefore, there is no question of getting your accounts audited, and your professional receipts are much less than the threshold of 50 lakhs in the respective year. That would take me to the next judgment of Madras High Court. Property income, how it is required to be taxed. Here, Madras High Court has made a very simple observation. High Court said that if it is a commercial property, it would always be taxed as a business income. I have a different take on the issue that merely because it's a commercial property, it cannot always be held that it would be taxed as a business income. It has to depend on the facts of each case. If you look at, in fact, the Sambhu Investments judgment, which is referred to by the Madras High Court, it is 263 ITR 143, Supreme Court judgment. Supreme Court is a one-line judgment. Ultimately, Calcutta High Court is the lead judgment, where there also the property was a commercial property, and that commercial property was let out. However, the Supreme Court said that if the principle is that if you are letting out a property and earning income passively, merely by letting out the property and earning the income, it could be taxed as a business income. It could be taxed as an income from house property, even if you have a memorandum of association saying that you are in the business of letting out the property. However, if it is an active way of earning the rent income, active letting out of the property means along with the property, you are providing some more services. Here, the facts are recorded that property together with amenities have been let out. So if you can demonstrate that there is an active letting out of the property, then probably you can claim it as a business income. If it is only passive letting out of a property without doing anything, you are just giving the keys of your property to your tenant and earning the income. And then you rely on two things, that one, this is a commercial property, and two, that my memorandum and article says that I'm in the business of letting out of the property. Probably you will have to answer the authorities. The better way is you demonstrate at least on paper that there is active participation by way of providing for various facilities, including security, canteen, parking facilities, building management, furniture, fixture, etc. on some active basis. All those things would go a long way in treating the income as a business income. Otherwise, it can very easily be treated as a property income, and you can be denied all kinds of expenditure which you have incurred. This law is also discussed in detail as to what are the activities which can be conducted in the judgment of Gujarat High Court 34 taxman.com 155, wherein the entire law is discussed again at great length. Next judgment is of Delhi High Court. Next, both the judgments of Delhi High Court, that is, one is 140 taxman 134, Principal Commissioner versus Harish Kumar, and another is Rita Kumari versus ACIT. Both are with respect to 148. The first judgment, Harish Kumar, the issue was with respect to, Harish Kumar is on penalty, my mistake. Harish Kumar is on penalty. That is Principal Commissioner versus Harish Kumar, 140 taxman.com 134 is with respect to penalty. The SSC, while filing return of income, did not take cognizance of 94(7). 94(7) is a dividend stripping provision which says that if you are purchasing a particular scrip, a particular share, and that share declares a dividend, then you cannot, within a period of 3 months, sell the shares and claim the reduction in the value as a capital loss. Insofar as units are concerned, probably the period is of 9 months. However, the principle is that you cannot do dividend stripping, claiming dividend as an exempt income, and then claim the losses by fall in prices by immediately selling after the record date. This SSC in question made a mistake while preparing the accounts. By mistake, it claimed the short-term capital loss, which he suffered because of the X dividend rate. During the course of the assessment proceedings, a show cause was issued, information were called for. While compiling the information, SSC realized that there is a mistake. So a case of the SSC is that on its own, it submitted a revised working, surrendered this income, filed a revised return of income. Ultimately, assessment was framed at the same revised return of income. However, penalty was initiated. The case of the assessing officer is that explanation 1, capital B is applicable because you have not furnished the entire details correctly. And second is that but for this scrutiny assessment, probably you could have got away with filing this incorrect claim. Ultimately, High Court accepted the version of the SSC that this was a bona fide genuine mistake. Large number of data was there, and there was some goof up on the part of the accountant in feeding the data. And based on that, ultimately, the case of the SSC was that there was a bona fide error on its part. And at the first available opportunity, it came clean, and therefore no penalty. High Court accepted that yes, there is nothing where we can attribute the mala fights, except for the case that, but for the scrutiny, probably this mistake would have never surfaced. We have judgments of the Delhi High Court again taking a view, and under such a circumstances, that such a mistake is fatal and penalty can be levied. You also have the judgments of the Supreme Court in the PricewaterhouseCoopers case that such a mistake, if it is demonstrated that mistake is a bona fide one, then one can certainly plead that there is no question of levying any penalty. However, it all depends on the facts of each case, and therefore one will have to be very careful insofar as penalty is concerned. There are 2 Bombay High Court judgments dealing with the reopening under the old scheme. One is that if there is no failure in disclosing fully and truly all material facts, there is no question of reopening beyond a period of 4 years when the original assessment is done under the scrutiny. That is in the case of Rita Rajkumar Singh versus ACIT 139 taxman 245. There was a scrutiny. Details as regards share transactions were called for, verified, placed on record, accepted by the AO. Subsequently, there was an investigation, and investigation revealed that the scrip in which the SSC dealt, there were certain price rigging done by the promoters. And therefore, based on that, assessing officer wanted to reopen the assessment. The argument of the SSC was that, sir, the information is with respect to price rigging, whereas it does not contain any information vis-a-vis me. So long as I have not carried out any of those price rigging or the transactions outside the floor of the stock market so as to jack up the prices of the shares, I cannot be attributed with a failure in disclosing fully and truly all material facts. High Court accepted that you are right to that extent, that there is no information vis-a-vis you, and whatever was expected from you, you disclose all those informations truly and fully. Next is again Bombay High Court judgment, where Section 68 edition was accepted at the time of original assessment. There was no new tangible material, no new information. Assessing authority said that now we want to revisit the whole thing. High Court said that this is nothing but change of opinion. More so, at the original stage, a specific show cause was issued. At the original stage, 133(6) communication took place between the creditors and the assessing officer, and those creditors sent confirmations directly to the assessing authority. Therefore, High Court said that reopening is not justified. And lastly, Delhi High Court judgment in the case of PCIT versus Future First Info Services is on the well accepted legal proposition that while disallowing any amount under 40A1A, the short deduction would not attract the rigors of that provision. It is complete failure to deduct tax at source which would attract the disallowance under 40A1A. The partial failure, namely deduction of tax at source at a lesser rate, would not expose an assessee to 40A1A disallowance. Delhi High Court, and in fact now we have judgments of various high courts, large number of high courts, taking the same view that a short deduction would not attract the provisions of 40A1A. It's only the failure completely to deduct the tax at source which would expose you to such a penalty.
Refer to Bombay High Court, that
Yes.
one petty stock that they Calcutta High Court in number of cases, group of cases, some I am told 80, 90 cases, on the basis of investigation report, they have just held against the assessee.
Right.
That is Swati Bajaj. One judgment is there. I think
Swati?
that is not Swati
No.
Bajaj.
Yes, Swati Bajaj was in fact a tax appeal.
Yeah.
It was not, yes, it was, I'm aware of the Swati Bajaj case. There they reversed the tribunal's order.
Yes, sir.
Yes. Whereas here, the only limited issue was, insofar as penny stock is concerned, the only issue was reopening. So we are, the Bombay High Court was only concerned not penny stock as a on the merits of the matter. Penny stock was only by way of a reopening. What the allegation was that you dealt into a particular scrip. Now, dealing into a particular scrip on the floor of the stock market is not per se illegal. So long as the scrip is available in the market, I can always deal into that. Now, at a later stage, investigation might reveal that there was a price rigging. So long as my involvement is not established, you cannot reopen my assessment. And to that extent, Bombay High Court was correct.
Correct. No, I'm saying 90 cases disposed of by one order. Maybe in all cases, facts may be different. But then so the High Court has decided accordingly.
Sir, when you play with fire, you can't complain of burnt fingers. If you deal in penny stock, if you deal in penny stock, you have to be, sir, I have so far not made any gain in any penny stock. I'm not very sure about others, but then we never get to earn such a money, and we all know what is the hard reality.
I know, sir. I know. I appreciate it.